Hey everybody, Chuck Barone, your long-lost host, back at his desk. It's Monday, July the 31st, 2023. And I want to start the show, of course, by welcoming everybody, as I do every day, to the show. We appreciate your guys' support, and I apologize for last week. We did our show on Monday, and everything was great. On Tuesday and Wednesday, we had these technical issues. I ended up having to buy some new equipment. And I was already planning Thursday and Friday was my annual boys trip up to Reno for golf and shenanigans. So I was already planning on Thursday and Friday off. I just didn't get a chance to let you guys know. So I apologize for all of that, but we are back and everything's in order. And let's get everybody caught up on what's happening in the world and these markets. All right, so let's look at the markets today. Today's all earnings, day-driven earnings coming in from Wall Street. Everybody's seems to be doing pretty good. So the market's happy. The Dow jumps 183 points today, 35,411 on the Dow. S&P up 6, broader market, 4588 on the S&P. The NASDAQ up 29 points, 14,346 on the NASDAQ. These are great numbers for stocks, guys. If you're a stockholder, if you're an investor, if you're a person who has, 401k invested in mutual funds or whatever, your numbers are probably looking okay, much better than they did a year ago, I'm guessing. The market's been on a tear this whole year. I think that the market's starting to actually believe that the Fed can pull off this soft landing. The economy is certainly fighting off the Fed rate hikes and a lot of other stuff it's been dealing with. So, not a surprise, stocks responding favorably to this. And as long as, stocks, let's face it, guys, stocks trade daily on rumor and all kind of stuff, especially in a Fed rate hike period like we're in now. But ultimately, the stock market is earnings driven, man. It's about what is a company earning and how many times that earnings can we get to on a stock price. I know this is old school thinking, but it's just still the way the market works, guys. And if you're buying a company that's growing and only has a PE of 5, it's probably a lot better than a company that's not really growing except by acquisition with a PE of 30, right? Anyway, stocks up, market looking positive. We'll see how long it lasts. Bond today, bond market steady. The 10-year not really moving up, just 1 basis point. So that's not much of a move for the bonds. Let me get this 2-year. I forgot to write it down. 1 second. Let's see. 2-year today, 4.88%, and that's just down 2 basis points. So the bond market behaving a little more normally today. Still surprising that bond yields coming down, because I guess the market still digesting the end of last week, and what a wild finish it was, right, guys? So here we sit with an overnight rate of 5.3% and a massively inverted yield curve still. Bond market I would like to see it trade a little less volatile, right? And maybe we'll get a little of that now, because it looks like the Fed has maybe, I say that with certainly not a certainty, the Fed will raise again this year. I believe they will at least raise one more time. Wall Street kind of believing they're done. We'll see. I mean, I think that if companies' earnings hold up and the job market holds up and inflation is still above their target, I still believe we're going to get at least that one more hike. And I don't think we're going to get down to their 2% target, at least believably, without another hike. So we'll see. The dollar today up very small, but still a good strong number for the dollar. 101.9 on the index. Sitting right in the pocket where it kind of is. I've kind of been gyrating a little bit. It went up to 104, then it went back down, closing in 100. Now coming right back up, kind of just staying where it is. It's in right now it's the strongest currency there is out there, at least in this basket of currencies, and the number reflects that. Metals today, gold and silver up very small, not a big day for metals. Gold up $6.30, 1,965.70 for gold. Silver up 42 cents, 24.72 for silver. So both gold and silver right where they need to be, right in that range to get to 2,000 gold and $25 silver. Oil, wow, price still spiking up another $1.27 today, $81.85 per barrel, totally obliterating, jumping right out of our trough there between 70 and 75 where it had sat for so long. Now this breakout, it has broken out like this a few times before. So I'm going to be watching this closely to see how long this one can last. Is this a start of something new in oil, or new higher prices, or is this one just kind of a temporary rally that's going to fold back right up and oil gets right back to its trough at 70 to 75. We'll keep a close eye on this for you guys. Bitcoin today up very small, up $57, 29,239 for Bitcoin. Still a good, strong price, man. I got to say, it's surprising to me. I was not a big believer in these cryptos. The more I'm learning about them, though, the more I'm starting to understand them. The more interested I'm getting, the more intriguing they seem to me. And Bitcoin certainly holding its own in the face of some very, very negative headwinds in the crypto market world, whatever. Making a believer out of me a little bit at a time. All right, like I do every Monday, let's talk about the news we're going to get this week and what we can expect, how it can affect our portfolios in these markets. So today we got the Chicago PMI index, Purchasing Managers Index, up nicely. Business is percolating. Purchasing managers feeling emboldened to hire and to, take on new projects, add on new costs to the businesses. So everybody happy there. Tomorrow, we'll get quiet day tomorrow. We'll get construction spending. We'll get the ISM Manufacturing Index. Those should be interesting numbers. On Wednesday, we'll get quiet day on Wednesday as well. The only thing we're going to get on Wednesday is the Mortgage Bankers Index. So between construction spending and the Mortgage Bankers Index, that should show us that real estate continues to hold up high prices, but really in decline as far as the amount of sales they're having. And I think these two reports will both reflect that. Thursday is our big day, guys. Thursday is the day. We'll get the market moving day, I guess. On Thursday, we're going to get factory orders. How are manufacturers doing here in the U.S.? That number is expected to be up. On jobless claims, it's also coming up on every Thursday. Last week, 221. This week, 227 expected. It's been actually able to beat these numbers pretty handily, very regularly. So it'll be interesting to see where jobless comes in this week. Productivity. U.S. productivity is expected to have shown it rose 6.7%. Is that right? 2.7% in the last quarter. I was going to say that's a big number. 2.7% in the last quarter. So U.S. productivity up, and we're also going to get unit labor costs on Thursday, which is a really important number the Fed's going to be looking at. That is going to show unit labor costs up 2.6%. I'm not sure what the Fed's target number there is, but unit labor costs continuing to rise. On Friday, to close out the week, we'll get the non-farm payrolls report, a fancy name for how many jobs were created in July. And that one shocked us last month. This came in at 221,000. This month we're expecting 200,000 new jobs in July. So we'll see if they're on target or how it works out. And we'll also get the new unemployment rate on Friday, which is expected to be unchanged at 3.6%. Okay? All right, so let's look at a couple quick items before we sign off today. Banks, as we've been talking about, tightening their lending standards, making it more difficult to obtain credit at the same time as loan demand is coming down. Both businesses and consumers not applying for new credit, still applying, but less than, right? So the demand for credit is falling at the new higher rates, at these new, it's a new world for credit, it is. It's more expensive to get it, it's harder to obtain it, more expensive to carry it. We'll see if this leads to any kind of fundamental change in the way people think about debt, the way businesses think about debt. I doubt it. I would say it's much more likely that rates come back down to cater to these debtors who we need to keep the economy going, right? So lenders, the reason they're tightening their standards, which I thought this was interesting, they're saying that we have an uncertain economy. Stock market's certainly not showing that. They're expecting continued deterioration of collateral, which means the collateral that's supporting these loans coming down in value. And they also cited the coming commercial real estate crash and exposure to that for higher standards. Now, on the consumer side, between the giant rate hike from basically 0 to 5.35% and already astonishingly high debt levels on credit cards, it's not a surprise that consumers are kind of having their fill of high interest rate debt, expensive debt. And it's just interesting that that's happening at the same time as lenders are feeling kind of the same way. I think that, banks are going to have, this is a natural reaction they always have. They always seem to be on the wrong side of the timing and the wrong side of these markets. It's interesting to me because they're supposed to be our best and brightest, right? Anyway, so there we sit with that. Also, interesting, I was reading an article, they said, why have American consumers not really been affected so much by all these rate hikes? Well, here's the interesting thing. They said that only 11% of all household debt in the U.S. right now has variable rates. So basically 90% of the debt is locked in at lower rates. Mostly mortgage debt, right? Car loans. So that low percentage of variable rate loans is keeping Americans at these minimal payments, keeping them spending money. Now what's interesting is in 2000, at the turn of the century, variable rate loans were 25% of the market. And I think a lot of that has to do with 2007, 2008, where so many people were in variable rate mortgages, the subprime fiasco, and that really turned everybody off, including lenders, away from variable rate interest. What's interesting is right now, the statistic said 70% of all mortgages in the U.S. carry an interest rate of less than 4%. So that tells me that until interest rates come down pretty significantly, 70% of the houses are not coming up for sale. People do not want to sell when they have a mortgage at 3.5 to buy a new house at 6.5, 7.5. Rates continuing to rise in mortgages. So new debt much higher. Consumers at record levels of debt, not really having much of an appetite for much more high interest rate debt for sure. So let's see if consumers can stomach these new rates. Let's see what kind of appetite they have for new lending. I think that these rates are, as I've said many times on the show, this is the new normal, guys. We're going back to more sound financial policy or monetary policy, credit policy, where they're not encouraging people to take on record levels of debt, and certainly a better environment for savers to encourage people to maybe save a little money. With all of a sudden returns on your savings getting up toward 5%, not too bad. Anyway, that's it for markets. A couple of quick notes. I saw today Paul Rubens, who everybody knows as Pee Wee Herman, passed away today. A sad thing. He was a funny guy. And happy day for Chuck. On Thursday, we're going to have the Hall of Fame game, which kicks off the NFL season. Now, it's only a preseason game. I'm still going to watch some of it, though. But NFL here, which means everybody's in a better mood, especially your host. Anyway, guys, that's it for the day. I appreciate your support. Sorry for the fiasco that was last week. We will be back here tomorrow to bring you guys the news you need. Until then, guys, take care. Thanks.